Hello investors and traders, and welcome to the weekly market report with Market Guys. I'm AJ Monty. This is a one-year daily candle chart of the Dow Jones Industrial Average ETF, ticker symbol DIA. And if you've been following along with the Market Guys reports, you'll know that I leave my lines on the chart as evidence so you can see just how accurate technical analysis is, especially when we're using the candle charts like I have them set up here. One of the questions that I had come up this week was from one of our followers who asked, how do you know where to place the forecast line, and how do you know the angle in which to place them on the chart? So to answer that question, let me just tell you, you can see right here, this is the line that I drew last week from Friday on after the close. And I drew that line parallel to the previous line. If you look at the market, you'll see that when the market rallies, it has a tendency to move up in these angles a little bit more than 45 degrees, and when it sells off, it usually sells off in a dramatic way. As fear takes over in the market, prices tend to drop faster than they rally. So that's how I do the forecast, and then what I try to do is go about a week or two out in time. You can see that each week has about 5 candles in it, unless we have a shortened trading week, and that'll have 4 candles in it. But you can see as I zoom in, the market hit the end of the line. The end of the line, by the way, is my target price. So today we closed, this is March 9th and I'm recording this, we closed almost exactly to my target price right there. And you'll notice that today's price action was a nice long green candle. A lot of optimism came into the market today, combined with some short covering, which added to that upward momentum. But notice down here that the volume is about 25 to 30% less than what we had on Thursday. So that tells us that although the prices went up, the momentum on the buy side is starting to slip. So what I'm going to do is I'm going to erase all lines. Now that you see my past history in forecasting, I'm going to clear all the lines and draw some new lines for you. This is a resistance point right here for the Dow. And while I think we could move up a little bit more on Monday and Tuesday, I think ultimately we're going to see a continuation in the drop of that volume right there. So by the end of next week, I think we will pull back and test the 20-period moving average, but also you'll notice there's a little gap right there, right where the arrow is, right there. There's a gap, and with the Dow, 80% of the time those gaps fill. You can see here on the 23rd, which was the first trading day of the following week, it gapped up. Well, it only took 2 days for that price gap to fill, and you see that red candle there after it filled. So I think we're going to see the same thing, a little bit higher Monday and Tuesday, pull back to fill the gap, and I'll leave that in place right there. Now if I go to a more broad-based index, which is the Russell 2000, we hit my target number yesterday, and we went a little bit further, which is to this line right here. I said that is the gap fill target price, and we filled that gap perfectly. Now, one of the other rules for gap trading is something you have to know. It's very important, is that 80% of the time gaps fill, but 80% of the time after they fill, prices reverse. Now, there's still a lot of momentum here in this green candle, so I'm going to erase this line. I'm going to move it up just a little bit because I think next week the Russell 2000 will test the highs right there before pulling back, just like the Dow. So that's what I think the price action is going to look like for next week, and we'll see whether or not that comes true next Friday when I go back and do my report and review these lines. Okay, let's look at the S&P 500, known as the Spiders, ticker symbol SPY. See here, same thing, just like the other markets. We hit my target perfectly. We gapped up. The S&P rallied on higher volume. Interesting, isn't it? So I'm going to erase this line here, and I'm going to erase the previous line from that last forecast, which is also accurate, and I'm going to draw a new line. I think that the S&P is going to go up to fill that gap right there, because there's a gap off to the left, and then pull back to fill the lower gap. So again, to review, there's an open gap here, hence the reason why I'm drawing that line as a target. Once that gap fills, I think we're going to pull back and make an attempt to fill the gap to the downside. So that's for the S&P. Now let's look at the Qs. We had a lot of movement there. Not only did we hit my target, but we blew through the resistance area on the Qs. Zoom in here. Again, this was my forecast from last Friday. Remember, all this price action was not on the chart when we looked at this last week. This was my forecast, and on Thursday, hit my target, gapped up today on higher volume. So now what's going to happen, again, I'll erase my lines and crunch the chart a little bit. I'm going to move this price axis down just a little bit here. So now that we have a breakout occurring on higher volume, I think the Nasdaq could go a little bit higher, and then we're going to pull back to test that support level. We might even get a low, an intraday low, filling that gap. But once that gap fills, good chance it'll reverse after that fill price, and then we could see maybe a little bit of a bounce. But I'm not going to get too far ahead of myself here. Let's just look at this as the forecast. A little bit of a rally in the Qs, possible pullback towards the end of the week. Now, what's most interesting is the VIX. Look at this. I mean, talk about pinpoint accuracy in forecasting. This right here is the line that I drew. Let me highlight that in blue for you so you can see it over the red. This line is what I drew last Friday. Here was Friday, right? Monday, Tuesday, Wednesday, Thursday. Here's today, Friday. The reason I said we would go lower is because we had these long shadows above the candle, which tells us that selling pressure is moving in to the VIX. Now, also remember, the volatility index is inversely related to the S&P. So what I'm going to do here is I'm just going to continue this down because I think the VIX could just drop to test that support level and then bounce later in the week. So I'm going to leave that in place for you so you can see. I think we'll see a test of that support level, which is a role reversal support. Once that support is hit, I think we're going to bounce, which is going to cause the S&P to drop with maybe some profit taking and selling action coming into the market later in the week. Now, if you'd like to learn more about what we do at The Market Guys, just go to themarketguys.com and click on the video tab. Right there at the top of the page is a link that will bring you to our video library. In this library, we have what we call market shots. These are very short educational videos that you can review to get a feel for what we do here and learn the language, so to speak. One of the things I'd like you to review is trading the gap. That way you'll know the 80-20 rule and how to apply that to gap trading. Remember, 80% of the time gaps fill, 80% of the time after they fill, price reverses. And you'll see why that happens by watching that video. Again, very short, about 7 minutes long. Fit into your schedule and go from there. So I want to thank you once again for following The Market Guys. Have a great weekend, and we'll speak with you soon. So long.
This video segment is a small part of what The Market Guys offer through their educational products and services. If you are interested in any of our trade alert services, or you would like more information about our one-on-one mentoring program, simply contact us at info@themarketguys.com.